All right. Good evening, everyone. Thank you again for joining us for part 2 of our Economic Empowerment series. I'm Kimberly Saunders with the Central Florida chapter of the National Black MBA Association. And on behalf of the board, I'd like to welcome you this evening. If you missed part 1, please feel welcome to go to our YouTube page. The entire session is posted. This evening, we will be discussing part 2, which involves entrepreneurs as well as small business owners and the options that they have for investing in retirement plans that are available to them. First, I do want to thank our sponsor and partner this evening, which is Charles Schwab, who has been our partner for the last few years in our economic empowerment sessions. And I do want to give an opportunity for Chasey Tonge, who is our liaison with Charles Schwab, to say a few words on behalf of the organization. Chasey?
Thank you, Kimberly. Hi, good day, everyone. My name is Chasey Tonge. I am the national chairperson for our Black Employee Resource Group, and we are here to partner with the National Black MBA Association for the Financial Literacy Month and bring to you information on how you can be a part of, like Schwab would say, owning your tomorrow, and find out information about how you can, some resources that are available to invest if being a small business owner or if you're pursuing entrepreneurship. So with me today, I have a couple of my colleagues. We have Hayden Adams and Ann Pot, and they will be the ones who will be presenting our topics today. So with that said, Kimberly, I'll turn it back over to you.
Thank you so much. And before we do get started, I do want to make sure that everyone is aware this is a 3-part series. So next week will be our part 3 and final series, our final discussion. And we're also having that in conjunction with our quarter 2 general chapter meeting. And so next week, we will have a panel of local franchisees that will be talking about wealth building through franchising. So definitely join us for part 3, which is next Wednesday, May the 3rd at 6 p.m. Eastern Standard Time. I will now introduce our guest speakers for the evening, and feel welcome. It's just a short introduction, so feel welcome to go into more detail about your background once I introduce you. So we have Ann Fott. She is the Senior Product Management Manager and has been employed with TD Ameritrade / Schwab for over the last 22 years. And we have Hayden Adams. Hayden is the Director, Tax Planning and Wealth Management. Hayden holds both his CPA as well as CFP, Certified Financial Planner certification, and has been employed with Schwab for over 7 years. So Ann, if you would like to give us a little bit more about your background, and then followed by Hayden, and then we'll get started in the discussion.
Hi, everybody. Thanks for having me. I started at TD Ameritrade back when it was actually TD Waterhouse back in 2000. Prior to that, I had worked at Prudential Securities as a financial advisor. And I had, back in 1998, when Roth IRAs came out, I decided to focus my business on retirements. So much like many of you, as a financial advisor, I was an entrepreneur trying to build my business. And I was using retirement plans as the basis to build that business. After a few years, I decided I needed a little more stability, and I moved over to TD Waterhouse. That became TD Ameritrade, which will soon be Charles Schwab, back in 2000, and started my career as the institutional retirement plan services desk. And what we primarily focused on was advising financial advisors on retirement plans. And as you can imagine, over the past 22 years, there's been many changes in the retirement world, and it's one of the things that keeps it exciting.
Thank you, Anne. Hayden.
Oh, I agree. It definitely keeps things exciting when Congress comes out with new tax laws, and that's what I do here at Schwab. So I'm basically the chief tax strategist, kind of everything tax. And tax is a unique thing that it covers so many aspects of your life. Doesn't matter how wealthy you are. Doesn't matter where you come from. Tax is going to have an impact on you. And it's actually, believe it or not, it's actually the most clicked on topic on schwab.com. You'd think it'd be investing topics, right? It's taxes. And my background is I was a former IRS agent. I specialized in ultra high net worth audits. So people who owned like football teams and stuff like that for fun. And I bring that same level of knowledge here to Schwab to say, like, well, here's what the wealthiest people are doing. Here's what the people, the most savvy tax planners are doing in order to maximize their after-tax returns. And that's what I want to talk about today, is some of those strategies that you can use as an entrepreneur, as a business owner, just as an individual, that can potentially reduce your taxes, leave you with more money in your pocket that you can spend or invest.
Awesome. Thank you so much. I will say this, I'll go back to last week as we introduced part one, and that talked about equity compensation and really, employee benefits, right? So when we're working professionals, when we work for companies, most of the time we have benefits packages that are available to you. However, when we take that leap of faith and go out as entrepreneurs and become business owners, we have to create those things ourselves. And so one of the things is that we wanted to, of course, have this session because a lot of times, we can focus on the career professional where those things are already laid out for us. But more and more these days, we see individuals going into entrepreneurship, or even if they are working professionals, they may start something on the side that may develop into, full-time entrepreneurial endeavors. So we want to really focus tonight on if you are an entrepreneur, self-employed, or business owner where you may have other employees. We want to provide to you some of those resources that are available to still prepare for retirement. So I think that we've probably all heard, that we have retirement worries in this country, right? Regardless of what generation you're from, we've probably seen our grandparents, parents, ourselves, and then of course, younger generations. If we don't properly prepare, it's going to continue to be an issue. So definitely, I want to make sure that this is interactive discussion. Please feel welcome that if you have any questions for our guests tonight, you can drop them in the chat. You can raise your hand, and we'll definitely have a Q&A towards the end for any questions that you may forget. But please feel welcome to engage with us, share in the dialogue, because we want to make sure that we answer all of the questions that you have with you this evening. So I'll just start with a general question as far as when someone goes out on their own, they become self-employed, what options do they generally have that's available to them? And Hayden or Anne, either one of you can jump in there.
So I think, one of the most important decisions you can make is how to save for retirement. It's actually one of the, I call it the 4 key pillars of reducing your taxes. Is you have very specialized accounts available to you in the form of tax advantaged accounts, whether it's a Roth account, traditional IRA, 401k, individual 401ks. There's a huge number of options, and I'm sure Anne could get into all the details and benefits and pros and cons of each of those. But I think the big thing that I look at from a tax perspective is, you got to utilize these accounts. They're amazing. They have awesome benefits. The taxable brokerage account or your bank account, it's the least tax efficient of all your accounts because before you can save in it, you have to pay taxes. Then you put the money in there, and whatever assets grow and flourish, or produce interest and dividends, again, you get taxed on those. And then finally, if you liquidate the account, all those taxes come due one more time because any additional capital gains produces more tax. Where with these tax deferred accounts, whether it's Roth or any of these other types of tax advantage accounts, depending on your financial situation, if you can maximize those accounts, it can leave literally tens of thousands of dollars more in your pocket, because of that compound growth that can happen over years and years of not being taxed. Now, with the tax deferred accounts, you pull the money out, you're going to be taxed like a traditional IRA. With a Roth, you're going to get taxed up front, but then it gets to grow tax-free. And then when you pull the money out, there are no taxes. And the real kind of the sticking point is like, how do you choose between those? And we can talk about that a little bit more. But I'll turn it over to Ann and let her talk about some of the different account types that entrepreneurs can use.
Hi, thank you, Hayden. That was a great lead-in. Let me share my screen real quick here. Can everyone see this?
Not yet.
There we go.
There you are.
Are we good now? All right.
Something's coming up.
It's coming.
Nothing's popped up yet, though. Okay, now we can.
Yep. So as Hayden said, as most of you are hopefully aware of, there are traditional IRAs, which are generally pre-tax contributions, or there are Roth IRAs, which are after-tax contributions. And that's a great starting point when you're first starting out. But the limits that there are limits of what you can contribute each year. For 2023, if you're under 50, it's 6,500. If you're 50 or over, you can do an additional 1,000, which is 7,500. But even if you start at a very young age and save every year judiciously, that's not going to get you a good retirement. What do you want to say? It's safe haven by the time you reach retirement age. Even if you start in your early 20s, that's still not going to be enough to comfortably retire by the time you're in your late 60s or early 70s or whenever that may be. So there are some other plans that are specifically geared towards small business owners. And be it whether you're an entrepreneur, like an owner-only plan, like a hairdresser or a consultant or a gig worker, which is kind of a new acronym these days, or even a small business owner, like a florist shop or a small restaurant. You don't have the luxury of an employer-sponsored plan. And often many small business owners fail to save enough or make it a priority to start saving for retirements. So today I want to share with you at a very high level some of the potential employer plans that are geared towards small business owners. As you will note here, Hayden made mention that today we have traditional IRAs and Roth IRAs. Historically speaking, the majority of employer plans have all been pre-tax dollars. The only plan that allowed for Roth salary deferrals was the individual 401k or the 401k plan. But historically, the SEP and simple plans did not allow for Roth type contributions. Secure 2.0 has changed that rule. Technically, starting legislation was passed that actually made Roth SEPs and simples allowable today. However, we are still waiting on regulations from the IRS and Treasury on how they will operate. So even though in theory, legally they're allowed, we don't have the regulatory background behind them yet to even understand exactly how they'll look. So keep that in mind as I go through some of these features, because there are some exciting in the coming months. I will SEPs and simples sometime, hopefully by mid next year. So to start, SEP plans are primarily geared to owner-only plans or very small, tightly held owner-only companies. They are extremely easy to set up, and they allow much higher compensation limits than your traditional IRA would, which once again, 6,500 or 7,500 if you're 50 or over. As they are purely funded via employer contribution. So once again, excellent fit where the employer is making all the contributions and it's an owner-only plan or a very small, tightly owned company. The maximum contribution here is 25% of compensation up to a max of 66,000. So for instance, if you make 100,000 a year, you could, in theory, make a contribution of 25,000, etc. They have very, very flexible establishments. You can still establish a SEP for last year up through tax filing deadline plus extensions. And SEP IRAs are that. They're IRAs. So once you've contributed to your account and or your participants' accounts, they're completely owned and controlled by that participant. And just like with IRAs, there's no withdrawal restrictions, but there's also no vesting and there's no loans. Some qualified plans allow for loans. Profit sharing plans and 401k plans can allow for loans, but do not have to allow for loans. A vesting schedule, which is what can distinguish a profit sharing plan from a SEP, means in simple terms is if you contribute on your employee's behalf and you can contribute to them, you can put a vesting schedule in it. There are different types of vesting schedules, but let's just say if you put in a 5-year cliff vesting, what would mean in that situation is if you started contributing to your employees' accounts in year 1, 2, 3, and they left the company and you had a 5-year vesting schedule, they would not be entitled to any of that money. So that this can be an attractive feature to small plans with employees, especially if they have a high turnover, but still want to have an attractive plan to attract key employees. So once again, both the SEP and the profit sharing plan are pure employer dollars, but they both have much higher compensation caps than your traditional or Roth IRAs would have. And once again, the key differences here is that with a SEP, it's an IRA account, so the participant controls total asset to it. There are no withdrawal restrictions. While with the profit sharing plan, there are withdrawal restrictions. You can have a vesting schedule and you can have a loan. So
Hey, Ann, I want to take a pause there to see if there's any questions. I know that was a lot of information, but thank you for breaking it down like that. Are there any questions over the SEP as well as the profit sharing before she goes on? And feel welcome to come off of mute or drop your question in the chat box.
I think one of the things, Kimberly, that a lot of people run into when it comes to these plans is that A, there's a lot of them. B, there's all kinds of intricacies when it comes to setting them up. How do you administer them? Operationally, how do you take care of this kind of stuff? And I think one of the takeaways is that, like, this is the benefit of working with a financial advisor who can kind of guide you through that process. And both Schwab and TD have people who can actually help you determine which one is going to be the best fit for you, specifically like which one's going to be the lowest cost to administer. because there is paperwork to do for some of these plans. So there are costs associated with some of them. Which one's going to get you the highest contribution limits? Because for some people, like maybe you're just starting out as an entrepreneur, and as Ann pointed out, the traditional IRA, it's not that big of a dollar amount, but like maybe at first you won't be able to contribute as much because it's a startup business, right? And you don't have excess income and you want to roll that income into your business. So maybe the easiest one for you will be a traditional IRA, because it kind of depends on how much you can contribute. But then as your business matures and grows, then something like a SEP might be very appealing. Like you got $200,000 worth of income, and you can potentially contribute up to 25%, which means you're at $50,000, and it's like, and that's not going to be a strain on your personal financial situation or your business to make those kind of contributions. Then maybe you move towards those other kinds of plans. But one of the things that I find here is that a lot of times the decision is easier than you may think. Simply because, yes, there are a lot of options. There are a lot of tax rules, because these are all tax-based systems. All of them are like the 401k is tax section 401k of the Internal Revenue Code, right? Well, each one of them kind of fits in, generally speaking, into a specific point in your life. And so sometimes the question of which one should you do is actually easier than you might think. And you can answer that question with a few simple, like, well, how much can I contribute? And is a tax deferred better for me or a Roth? And maybe that's something I can talk about right now, is like, how do you determine which account type is best for you? Because one of them, you get a tax deduction up front. And then the other, you don't get a tax deduction up front, but you don't pay taxes in the future. And that might be the first decision. It's like, well, which one should I do? Well, the simplest way I can describe it is if today you're in what you consider a pretty high tax bracket, and you think in the future, when you pull out that money, you're going to be in a lower tax bracket, then those tax deferred accounts, like a traditional IRA or a normal 401k, something along those lines, like a SEP, those might be the one that makes the most sense, because you're going to contribute today at a higher tax bracket, get that tax deduction, which means, like, say you're in the 35% tax bracket or something right now, right? But you think like, well, when I'm in retirement, I'm actually going to be in a lower tax bracket, which is kind of common for people. As you go into retirement, your income tends to drop off a little bit. You pay off your houses and all that kind of stuff. And maybe you're in the 24% tax bracket in retirement, right? Well, the difference between what you contributed at and the tax bracket you paid your taxes at, that's kind of the tax alpha, I call it. How much did you save? Now, what if it's the other situation? What if today you're like, well, today I'm only in the 12% tax bracket, right? I'm just starting out in my business. I think I'm going to be in a much higher tax bracket when I retire. Maybe that same 24% tax bracket, right? Well, if you use a Roth today, that could be the one that makes the most sense, because today you're going to pay a lot less taxes than you would in the future. So by contributing to the Roth, you're front loading the taxes. Then when you go into retirement and you want to pull the money out, well, you're not going to have to pull it out and pay taxes at that 24% rate. So that difference there, that 12%, that's your tax alpha, that's your tax savings. So for a lot of people, it can be kind of a simple decision. Which one should I do? Well, it's like, well, where am I today versus where do I think I'm going to be in the future? And that'll kind of almost decide for you which account type makes the most sense. Now, what about people in their middle age, like me, right? Like, maybe I'm going to open a business one day. Maybe I'm going to make more. Maybe I'm going to get promoted. I don't know. I'm kind of like that point in my life where it's like, I may be in the same tax bracket in retirement as I am today. So which account do I choose? Well, you can kind of hedge your bets if you're just not sure. You can contribute a little to a Roth and a little bit to a traditional tax deferred account. And by doing so, you're kind of hedging your bets, saying like, well, I'm not sure what's going to happen, so I'm going to put a little money in either of them. And the reason it's a good hedge is because if you do that over your life, like, so imagine you're young, the simple example, a young person tends to make less than a person in their 50s or 60s, right? So as you're young, you contribute to a Roth. As you get a little older and, your business grows and expands, then you contribute to both a Roth and a tax deferred account. Then you get a little older and you're like, well, I'm probably at my max earning potential, or maybe I'm in the highest tax bracket, right? Now that's tax deferred only, right? And then after you retire, now you've got both tax deferred accounts, Roth accounts, and if you're a really good saver and you max those all out, you also saved in a brokerage account, right? So now you've got 3 account types, and I call this tax diversification. So now you have 3 options to pull your money out in retirement, which means you can kind of play a little game of like move the, like the people put a card, which card, out in New York City and stuff like that. And you can play that game with the IRS and say, which account am I going to pull my money from? And you can arrange your distributions in a way that minimizes your taxes as low as possible. And so like it gives you options. And that's why like a lot of people are very concerned, like, oh, I should only contribute to this account because I read an article that it's the best. The Roth is the best. Roth's a great account, right? But it's only great if you're going to be in the same or a higher tax bracket in the future, because you could actually harm yourself in not making the right selection. And that's why it's important, and kind of the thing you'll hear me harp on the whole time is like, it's important to talk to a financial advisor, a planner who has the experience working with business owners, who can actually guide you through that process and say, okay, like, what is it you're looking for? Where are you today? Where do you think you're going to be in the future? And they can help plan out like which accounts that make the most sense for you. And that could change yearly. I mean, as your business grows, as things change in your business, you may expand into, from a SEP into an individual 401k. So they also call it a solo 401k. You might try all kinds of different other contribution plans. Like there's even defined benefit plans where you can contribute an insane amount of money to them. So like if you're a person who has like extremely high income, like say you're a doctor and you own your own medical business, right? And you're making $400,000 a year. Well, you could say like, well, I want to have a certain amount in retirement to live on. So I'm going to have a defined benefits plan, and I'm going to contribute you could contribute like $150,000 a year or more to those to get the benefit you're looking for. So there's all kinds of different ways you can plan this out, and it's very individualized and very personal.
Great, thank you so much, Hayden. And there was a question that came in the chat. I just want to make sure, I think you answered it during your commentary. Are there tax benefits yearly for contributing to an IRA? So I think for the traditional IRA, yes, there are tax benefits on an annual basis. For the Roth IRA, you don't get that deduction. So I just want to make sure that that's
right. And that's actually a really good question, because the traditional IRA it's a fussy account. And the reason I say that is and especially with the stuff that happened with Secure Act 2.0, all these, like Ann talked about this, where, now we can have potentially Roth that are, they call them designated Roth accounts in a SEP. Now, I don't think there's any company out there who has them yet. Even though legally you can have them, there's all kinds of back office administrative stuff that has to be put into place that hasn't been done yet. But there's some weird stuff going on. And one of them is that like with, for example, a Roth IRA, there's income limits, right? And they say, well, if you make over a certain amount of money, you can't contribute to a Roth. But they've got new rules in place now that say, if you make over $145,000 a year, we're going to force you into a Roth for your catch-up contributions. It's like, wait, what? Government? Like, so if I make a certain amount, you won't let me do a Roth IRA, but if I make a certain amount, you'll force my catch-up contributions into a Roth. It's like, this makes no sense. Well, that's the government for you sometimes, all tax laws are making perfect sense. And that does create complexity. And again, even if the traditional IRA, there's some complexity, because like say you've got, maybe you work a normal job and you're an entrepreneur, right? So you might have a 401k at work, and you've got a certain income from there. And then you're like, well, I also want to have a traditional IRA. Well, you may not get a deduction for your traditional IRA if you're sponsored by an employer plan and your income's over a certain amount and all these additional rules. And so then it creates a complexity. It's like, well, I want to contribute to an IRA. Is it going to be worth it anymore? And it's like, and I can't contribute to a Roth because my income's too high. How do I do that? Well, you can, and there's some really cool strategies. And I've got some articles on that on schwab.com. So if you just kind of Google Schwab, backdoor Roth is what we're going to talk about here for a second. You can contribute to an IRA. Normally you get a deduction, but maybe you couldn't because you're sponsored by a 401k plan, right? But you can still contribute to it. And then potentially you don't get a tax deduction. But what you could do is kind of take an end around those income limits and say, I'm going to contribute to that IRA, get that extra, $6,000 or so into the IRA. And then I'm immediately going to do a Roth conversion. And then now I got into the Roth account when they wouldn't let me because my income limits, right? So there's a bunch of interesting strategies you can use. And I use this personally every year because with the combined income of my wife and I, and we're covered by a 401k plan, I can't get a tax deduction for IRA contributions. And I want to get as much money in those tax deferred accounts as I can and tax advantaged accounts like Roths. So one way I do it is I make non-tax deductible contributions, and we do Roth conversions regularly to just keep piling up that money in those tax advantaged accounts because it'll pay off in the long run. It has some issues in the short run where I can't get to the money necessarily, so I want to have a kind of a nest egg of cash, but it helps me maximize potentially getting an early retirement, because that's kind of my, cross our fingers, that's what my wife and I are shooting for, is to retire at like 55 or something like that.
Absolutely awesome. Thank you so much for that. Anne, if you'd like to continue on with your slides there, make sure that we covered everything that you have.
Sure. So, thank you, Hayden. That was a great explanation, especially of there is no pro and con between traditional and Roth. It's your individual needs and what point in time you are to life. And also, and I agree 1,000% with Hayden, I'm doing the same thing myself, is I saved everything pre-tax for my entire career until about 5 years ago. And there's no excuse for me because, this is what I do for a living. And I finally realized 5 years ago it was time for me to start doing that tax diversification and putting some money away, Roth money. So even though I'm in what a lot of people would consider my high earnings years, it's also important to me as an individual to pad my retirement with some Roth dollars and not have everything as pre-tax. So segueing, so SEPs and profit sharing plans are purely employer money. There is no employee money allowed into it. So if you have employees, or in some cases, even if you're an owner-only plan, you can, a simple IRA may be the best fit for you. And simple IRAs are very similar to 401ks, which I think more of us are familiar with, in that they have both employee money and employer money. And the majority of the money comes from the employee side of it. So as you can see, these are the limits for 2022 and 2023. These are adjusted each year for cost of a living adjustments. So this is what each employee can defer up to 100% of compensation. And then as the employer, they have a mandatory contribution, which is a 3% match, which means if your employer is doing a 3% match, you only get the 3% if you're contributing 3% of your salary or more. If you're not contributing, the employer is not required to contribute on your behalf, even if you are eligible. So once again, it's a match. Or another option they can elect to do is a 2% non-elective, which is where they would do 2% across the board for all eligible employees, regardless if they are contributing or not. Once again, to Hayden's point, whether that 3% match or 2% non-elective is a better choice for you as the employer is really something that you're best to talk with a tax advisor or a financial advisor about. These are IRA accounts, so they are participant employed, which means there's no vesting. Because it's an IRA account, there's no plan loans, but because it's an IRA account, there's also no withdrawal restriction. So once that money goes into that simple IRA, it belongs to the participant, to the employee, and the employer ceases to have any control over it. So simples are a low cost way miss to the employer other than the matching contribution. unlike a 401k. A 401k has some benefits to it, but it also has some pitfalls to it. Generally, if you have a 401k plan with employees, and only if you have employees, it's going to require that you have a professional third-party administrator or a highly qualified tax advisor or record keeper to assist you in some of the complex requirements. There's an annual tax form that needs to be filed every year called a 5500. There's some testing that's generally required, although there are ways to get around that by offering a safe harbor plan. But to Hayden's point, there's all kinds of bells and whistles you can opt to have with a 401k plan, which is another reason it makes them attractive. And they also have some of the highest contribution limits, because not only do you have the employee money going in, but you have the employer money going in. And because of these higher contribution limits, where you can take the employee and the employer and reach a higher aggregate, especially if you're over 50, 401k plans are very popular among owner-only plans. They're often referred to as individual Ks, solo Ks, personal Ks, uni Ks, IKs. The idea behind them is that they're 401k plans for owner-only plans or their spouses. And due to the fact there's no employees involved, there's minimal tax reporting required until you reach 250,000 assets. Your contribution limits tend to be higher than you would get with a SEP or a simple. And there's none of the top-heavy or non-discrimination testing or the complications that makes a 401k plan cost prohibitive for some small employers. So once again, as your business grows, maybe at first you start with a SEP plan, or especially once you reach 50 and you want to start maxing out, you move over to an individual 401k. Or maybe you start out with a SEP plan and then you hire a couple of employees. So now you want the employees to be able to contribute on their own behalf. So perhaps you move over to a simple, and then your business continues to grow. 5 years later, you've added another 10 employees and you've decided that the simple is just a little too cumbersome to manage with so many employees, and you want to attract and retain employees. You decide you want to switch over to a 401k plan. I would advise that anytime your business changes or grows, it's time to reevaluate what type of plan you have and whether changing that plan makes sense for you. So they all have their pros, but they all have their different features, and they also have their cons depending on your situations. Hayden, do you want to add anything to that?
Oh, I think that was an excellent summary of the different plans. And frankly, it's only gotten more complicated with the Secure Act. And it's not complicated, I'd say, in necessarily a bad way. It's complicated in that a lot of those changes are really good. They're giving people more options. And I think more is better when it comes to these retirement plans. And some of those options include higher catch-up contributions for people between the age of 60 and 63. So like if you didn't save enough, you can save even more. I think like the kind of the big moral of the story, the narrative here is that when it comes to planning and saving for retirement, the sooner you can do it, the better. But don't be worried if you can't do it sooner, because a lot of people can't. Well, I know I barely saved when I was in my 20s. I just didn't have any money to save. My career didn't start off like with a bang. It kind of like sparked a little bit. Now, as I'm older, now I'm able to save a lot more. And I think that's the thing, is like, you shouldn't let yourself get frustrated if you feel like you're behind, because I read those articles out there, and I read them back when I wasn't saving this much, and it was like, oh, the average person's 401k balance is X, and and where do you stand? And it's like, yeah, it's great for clicks, but it can also cause some stress when it comes to planning and saving. And the key here is that, like, fortunately, as you reach those higher income years, is that the limits actually do increase. So like once you're over 50, you can contribute more and you can save even more when it comes to the 401k, when it comes to all these different plans. And, that's where we can like kind of plan for that and say like, hey, like, do I need the new car or do I need to like contribute more to my retirement plan? And it's like, and that's me. I'm like, cars aren't important to me, so that's not a big deal. But I mean, I don't even want to tell you how much my mountain bikes cost, because like, but that's important to me, like my mountain biking, and and unfortunately, every time I buy myself a mountain bike, I have to buy my wife one too, so it's like double the cost. But like that's where we can kind of like weigh and measure and say like, okay, what are the needs, and doing a financial plan can help that. Sitting down with a financial planner and saying like, here's my goals for retirement, here's the cash flows I'd like to have, here's the things that I want to achieve. And like really planning that out can help you focus on, okay, here's how I can save and relieve some of that stress. Because I personally, I'm a certified financial planner, but I have a financial planner at Charles Schwab. So we have free planners who work with us. And I like that. I like having an outside person giving me advice, because I'm a little conservative. They looked at my accounts and they were like, why on earth do you have this much cash? And I was like, well, because I'm scared of the stock market. It's like, and they were like, no, come on, Hayden, like really, like that's silly. Invest your cash. You don't need this for years. You want to get some return. And it's like, so it was good to have that person looking over my shoulder. And so I was doing a great job saving. There's no doubt about that, because I live in a modest house and I drive used cars and all that kind of stuff. But I wasn't doing a great job investing, because that's not my thing. And so like it's great to have that extra person, that partner. So like, for example, if you're running your business, right, you don't want to like deal with deliveries. You want to have UPS do that for you. Well, that's kind of how I see it. Like, I want to outsource some of that help that I might need when it comes to planning, and because I don't know everything about planning. I may be a financial planner, but like I specialize in tax. So I like to outsource a lot of those aspects of my financial life to someone else to give me advice and guidance and put me in the right direction. And that's the real thing that I'd say, like, to take away from everything in this presentation, is that like there are people that can help you. There's people that can guide you through this process and take away some of the mystery and kind of tell you about some of the pitfalls. Because again, I can tell you all kinds of stuff about these account types, and so can Ann. But in the end, like, we've built up years of knowledge about this stuff, and we can educate you a little bit about it. But in the end, like, it's probably going to take that next step of working with an actual planner to figure out exactly what makes the most sense for your particular situation.
Absolutely. Thank you so much, Ann and Hayden. So we have a couple of questions that came in. How easy or hard is it for employees to manage their plans after they leave your employment? So from a business owner perspective, if you have employees and your employees leave, how easy is it for them to take those plans that are the SEPs, that are the simple IRAs, for them to move those?
I'll take that one. It's very easy. If it's a SEP or a simple, you can actually just leave them sitting there and they will continue to be a SEP or simple for the life of the account, because the employee controls that money and the employer has no authorization or oversight on it. You can even transfer your SEPs and simples to other custodians at will. Or if you really don't like the idea of having a SEP IRA or a simple IRA, you can open a traditional IRA and transfer those assets internally to an account at Schwab or any custodian you're working with, or externally to any other custodian. There's a few little codicils with simples I'm not going to get into. Once again, there's so many nuances, I don't think we can cover them all here and give it justice, but very easy. With a SEP or a simple, it's simply a transfer, no different than moving an IRA to an IRA. With a 401k plan, that you would generally have to contact your former employer and complete their paperwork. to roll it into your own IRA where you could control the assets. But once again, you should look at the costs of investments inside your 401k versus similar investments inside of your IRA. Just a little disclaimer there. So a little more work to do a rollover from a 401k, but I would encourage anyone on this call who has a 401k at a former employer, once you've left that employer, just don't let it sit there for years on end, because you'd be amazed at how quick 10 or 20 years goes by and you forget about that money.
Absolutely. And I think that goes with another question. So the question was, should someone decide to leave their job and venture into the entrepreneurial space, should you leave your money with your money in the 401k plan? If not, what are some options? And I think you just answered that. If you leave it there, you could forget it's there. You're not, going in and managing it appropriately. Your risk tolerance changes, right, over time.
Right.
So you need to make sure that you're actively managing those funds.
Right. Exactly. There are pros and cons to it. 401ks tend to have a lower cost because they're institutional type shares, but most 401ks also limit your investment choices, and who knows what quality they are. And with at least with your IRA account, or if you open any of the accounts we just spoke of, a simple and individual K, you can roll your former employer's money into those accounts and still self-direct them either on your own or with a financial advisor.
And I think another thing I want to point out about these different accounts, because I think Ann made a good point, you can forget about those accounts, right? That's actually a very common occurrence, is that people actually forget that they have accounts. We actually have a team at Schwab who constantly is like trying to find people like, hey, nothing's happened with this account. What's going on here? And here's a catch-22 that a lot of people forget, is that usually when you open those accounts, you list a beneficiary, right? And if you've listed a beneficiary, and it's like your ex, so you got divorced, that can usurp your will. The money could literally go to your ex, whether you want it to or not, because you listed them as the beneficiary of your account. So that's something to be very careful of when you're looking at like all these different accounts you have. Is you probably do want to have a beneficiary listed, but make sure you check those and figure out who exactly you want those assets to go to. Because what if you had like your brother listed and then you got married and you rather have your husband be listed? Well, it can cause some major headaches for, like maybe the spouse might be able to get the money back, but they'll have to go through legal means, because usually people just don't give up money when it's given to them. So like that's something to be aware of when it comes to like these accounts, is that like you want to kind of check up on them and make sure like the designated beneficiaries and all these different aspects of the accounts, and they're invested in the right things too. Sometimes you may forget, like, well, am I having assets reinvested, or are they being reinvested according to my new risk tolerance, or, are they being invested based on like my old risk tolerance? Like, like I said, I was kind of conservative, and, like I was basically having my dividends sit in cash, and I should have been having them reinvested. And so like, make sure, you're having everything like looked at and saying, okay, is this the kind of investments you're looking at? Like, are these the kind of risk tolerances you have? Are we, do we have all the proper boxes checked on all these accounts? Because that's a very common thing I see.
Absolutely, Hayden. And you made a very good point there, making sure that you're speaking with a professional that handles these things. And again, reach out to schwab.com, give them a call. They have professionals that are on staff that this is what they do all day, every day. And Hayden, like you mentioned, there's a component to that. It's not just retirement planning. There's an investment planning component. There's a tax planning component, estate planning component. So you have that professional there at Schwab that is able to remind you of those things. When you call and when you meet with your certified financial professional, they're asking you, have you updated your beneficiaries? Do they need to be updated? So don't feel like this is something that you constantly have to remember. That's what the professionals are for. So again, reach out to Charles Schwab. They have, the advice, the professionals that are on hand to help you do that. So another question that we have is, do retirement plans come with guidance, i.e. investment and taxes for the employees? So as a business owner, if I set up a retirement plan for my employees, does that come with guidance?
Ooh, I would say generally probably not going to see that. A lot of those that falls on the individual. So like the setting up the plan, like there's Schwab has, for example, retirement business services, and they help you set up a retirement plan. So they'll guide the business owner through the process of setting up that business plan. But then after that plan's in place, they're going to take care of maybe those administrative sides of things and the reporting to the government and IRS and all that kind of stuff. But to educate your employees, like not necessarily. I'm sure you could probably like talk to like say you had a financial planner, they might be willing to do some education or something like that. But yeah, unfortunately, a lot of that tends to fall on the individuals to educate themselves. And again, there's so much information out there. Like, where do you go to learn about that kind of stuff? And it is overwhelming, because you want to run your business, not focus on all this other financial stuff, right? So that's where I'd say, like check out like TD Ameritrade's and Schwab's website have immense amounts of content when it comes to educating yourself or employees. I would definitely, I've done a lot of presentations with TD Ameritrade recently, and they've got great education content. It's being kind of rolled over into Schwab, and becoming onto Schwab's website right now. But definitely, check out the websites, Google whatever thing you're trying to search for. And it's not just Schwab. I mean, there's lots of great content out there from all the big brokerage firms. And frankly, like I haven't seen too much of it out there that I'd call fly by night or untrustworthy. I do think you have to be careful though with YouTube. I'm a certified financial guru types on YouTube. They sound great, and like they stand next to their Lamborghini and they talk about like their financial plans. And it's like, I'd stick to more reputable content. Look for people like CFPs and CPAs and CFAs and those financial certifications, because they're held accountable, right? Like I have to be careful what kind of advice I give. So does Anne, because we can lose our licensing. And frankly, if I get bad enough, I could get myself put in prison as a CPA because that's a government license, So it's like we have like actual requirements on continuing education. We have requirements about what we can and can't say. Like, for example, all those articles that I write on schwab.com, they go through compliance review, levels of different review before they get posted. We have to track every change we make to every article. So like, you don't get that necessarily with some of those blogs out there. They can just, flip their opinion one day to the next. You never know what their old opinion was. Well, we're not able to do that. We have to like track all that kind of stuff. So be careful where you get your advice is one of my recommendations. And also check the dates on articles you're reading. That's the other big one I'd recommend, because like Secure Act just passed, right? So the article could be totally valid and real and talk about like, well, SEPs have this limit and here's the rules around SEPs, right? But if that thing was written before and doesn't take into account Secure Act 2.0, it's going to have different limits. It may not tell you about the fact that, Roths are now allowed to SEP accounts. So, be careful, when you're reading what's out there, because the internet is it's great for all the information, but it's also kind of unruly because anybody can post something. So that's just a heads up, because I've seen a lot of articles out there that still haven't been updated by even big brokerage firms have content that's a little old.
Awesome. Thank you so much. A question, in your opinion, at what point do you think those that become entrepreneurs should start to think about a retirement plan for themselves and then eventually for their employees?
Personally, sooner the better.
Yep.
I think that's like, obviously, the big key with any business is you want to, I tell people this all the time with taxes. Taxes should never be your primary concern, right? Taxes is part of the decision-making process. There's all these things that surround decision-making, right? It's the same thing with running a business. Like saving for retirement is part of the decisions. But like, obviously the main focus has got to be on running a profitable business, because you can't save for retirement. You can't do anything if you're not making net income. And so like, obviously you want to like get your business running, really get it sound. And once you've got like this really good foundation of a business, that's when, you know, I'd say like, yeah, that's immediately start focusing on like, I've got to start saving for my future. But again, you can only do that if your business is profitable and you know, producing the results and outcomes that you want.
Right. And I would also encourage, once you've decided it's time to start saving, that you do talk to a tax professional, because there's other benefits we haven't even touched on, Hayden. For instance, there's great tax credits that entrepreneurs can get for starting a new employer plan. And they Secure 2.0 made them far more attractive than they have been in the past. So talking to a professional in the long run will help save you money, not cost you money.
Yeah, that's an excellent point. And I totally forgot about all those new tax credits. Like, you could almost open one of these plans for free the first few years with those tax credits. So yeah, there's some great benefits to those. And yeah, unfortunately, you know, with tax advice, you know, there is a cost to it, but generally speaking, it's worth it. Like as a former IRS agent, you know, I've seen people try to do their own tax stuff, even, you know, very wealthy people, like who were like, you know, like they own a law firm and they were trying, and they were like, oh, I'm a lawyer, I know how to do tax stuff. And it's like, well, yeah, but your lawyer specializes in criminal justice, not taxes. And trust me, I had a lot of adjustments against them, you know? And so like, it is worth spending the money rather than having to pay the money later or missing out on something. Because, and that's one of the big kind of like other things that I see a lot of people do when it comes to this planning process, is that when it comes to tax planning or any planning for retirement plans or any of this kind of stuff, generally speaking, you've got to do it before December. Because yes, you can contribute to a traditional IRA up until tax filing deadline, right? But the vast majority of the best deductions you can get, the best tax credits you can get, their deadline is generally speaking December 31st. And you don't want to wait to the last minute. You want to do your tax planning right now for all of 2023, not, you know, like, you know, tax season just ended, right? You can do a little bit during tax season, but honestly, there's not a lot that can be done. What you want to focus on right now is planning for the future. And that's kind of like a big takeaway, is that like a lot of people wait to the last minute to do their tax planning, and it limits them, and they miss out on some big tax credits, like Ann pointed out. Like, I mean, there's some great deductions out there, but you have to know about them. You have to do all the paperwork. You have to jump through all the hoops. And trust me, there's a lot of hoops. and you don't want to make a mistake and miss out on potentially tens of thousands of dollars of tax credits or something like that.
All right, thank you so much. And it looks like we have in the chat box some of your posts, Hayden. So definitely check out some of Hayden's posts there. It's in the chat box for you. We are nearing the end of our session, so I do want to give an opportunity. If there are any final questions that we have, please feel welcome to come off of mute to ask them or put them in the chat box. And since Hayden was a former IRS agent, if any tax questions, I'm joking, I'm not going to put you on the spot to keep us all on the up and up. But are there any final questions that we have for Ann and for Hayden this evening? And I want to make sure I covered everything that came in the chat. Okay, doesn't look like we have anything. Any final words, Hayden, Ann, before we close out this evening? Any tips for entrepreneurs, for planning in general?
I'd say, frankly, I'm a little jealous of people who are entrepreneurs. It's like I constantly like thinking about like what way could I like build the great wealth, and this kind of anecdotal evidence here, but like honestly, the people who make it to the wealthiest heights, the top 1%ers, they're business owners. You know, like, and it's easy to see like celebrities and athletes and CEOs, and you think like, oh, that's the majority of wealthy people, but it's actually not. The majority of wealthy people are business owners, and most of them started out as a small business owner and grew their businesses. And that's what I actually specialized in. Like you think like, oh, well, all the billionaires are known. They're not, because if you own a private company, that information is not reported. And so there's billionaires. I audited tons of billionaires who like one of the garbage companies, or like little regional recycling thing, or like some warehousing business, or and it's like nobody knew because they own 100% of that business, and nobody knew how much wealth they had acquired. And that's what I kind of learned from that. That's why I'm jealous of people who are entrepreneurs, is because it's like that is the true way to build long-term wealth. And you know, part of the responsibility when you build that wealth is, well, what do you do with all that extra money? Well, you got to invest it and save it in a tax efficient way. So, you know, I hope all of you do wonderful. I hope you grow your businesses, and hopefully I'll be able to like take after you and start my own business one day too.
Thank you so much. Again, I would like to say thank you to Ann and Hayden, as well as Chasey with Charles Schwab. And as usual, thank you for the partnership. I'm just going to share my screen here for some final thoughts. Again, don't forget that this is part 2 of our 3-part series. So next week is part 3. We will have Wealth Building Through Franchising panel. If you're not familiar with our organization, feel welcome to go to our website, cflblackmba.org. And we welcome you to become a member, to take part in all of the programming that we have on an annual basis. If you're not following us on any of our media pages, make sure to do so: Facebook, Instagram, LinkedIn. We will also upload these videos on our YouTube page, so you can go back if there was any information that you missed or anything that you want to revisit. It will be uploaded on our YouTube page. And again, thank you so much to our sponsor for our Economic Empowerment Series, Charles Schwab, for parts 1 and parts 2. And as always, if you have any questions regarding Charles Schwab and their services, please feel welcome to go to schwab.com, reach out to their planners, their advisors for any of your financial needs. Thank you so much, everyone, for participating this evening, and have a wonderful night.
Thanks for having us.
Thank you.
Thank you.